Okay, so this is the doubt now. So module 18.2, second, so this is the doubt, okay? This is your doubt. So let's see now. Jamie Johnson, CFA, has been asked by her supervisor to evaluate the value of two stocks. Has been asked by her supervisor to evaluate the value of two stocks in the recreational vehicle industry. Evaluate the value of two stocks. Has been asked by her supervisor to evaluate the value of two stocks in the recreational vehicle industry. Okay. AAA Motorhomes and 3-Star Travelers, TST. Okay, these are two stocks. Johnson complied analyst information for the two companies in table 1. Okay. Compiled analyst information for the two companies in table 1. The expected return on the market is 11% and the risk-free rate is 4%. Johnson's supervisor has requested that Johnson focus on dividends in estimating the value of the two firms. Current return on equity, current EPS, retention ratio, beta. Table 2, confidence risk, time horizon risk. Confidence risk. Risk premium for AAA factor sensitivities. That means this is the beta. Okay, so all these are different
Additional
premium. These are all the factors and these are all the sensitivities. Okay. So now the question is sustainable growth rate for each firm.
That is something that I got.
Okay.
Then second one also I got. Fourth one,
Okay.
like the fourth
Okay.
one. Fifth one I found it difficult.
Okay. Johnson believes the estimates for TST using the constant dividend discount model is appropriate. However, she believes that AAA is expected to grow at a higher rate of 20% for the next 4 years and then grow at a rate of 7% after that. Using the two-stage model and CAPM for the required return, the current value. Okay, constant dividend discount model is appropriate. However, she believes that AAA is expected to grow at a higher rate of 20% for the next 4 years and then at a rate of 7% after that. Okay, so what is the problem here? So
in
first,
CAPM, yeah. So they
for
said
20% for the next 4 years.
yeah.
Okay, so currently what is the dividend? Current dividend.
Currently 250 into 2.5 into
Current
60%.
earning per share and retention per share.
Yeah.
So
So
2.50.
1.5.
Yeah.
1.5.
So 2.50 into 60%,
Yeah.
right? Which is
1.5.
what? 1.5. This is the dividend.
Yeah.
So here 1, 2, 3, 4 years, it is going to grow at the rate of 20%. 20% for the next 4 years. So 1.50, correct? This one?
Yeah.
So 1.50. So 20%, how much?
1.8.
1.80. 1.8, exactly 1.8.
Yeah.
Okay, so into 20%, how much?
2.16.
into 1 plus 20 percentage
2.592.
into 20 percentage
3.1104.
Okay, so this is the dividend, and then it will grow at a constant rate of 7 percentage after that. Okay, so 7 percentage. How much?
3.3281.
3.3281.
Yeah.
Okay, so this is as far as, so this is Gordon growth model. R is,
So we have to find R through CAPM. Here's where I got stuck.
okay, using the two-stage model and CAPM for the required rate of return, the current value. So growth is anyways 7 percentage. Required rate of return for the current value of AAA. So required rate of return. Yeah.
So beta is given. What is the premium that we should take? Risk-free rate is also given. So they have taken 7%. From where did they get 7%? So that I did not understand that.
Okay, confidence risk, time horizon, inflation, business timing, and then this is beta. Market risk premium, expected return on the market. Okay, so first is risk free plus beta into expected risk premium of the market. This is expected return on the market is 11 percentage.
Sir, they have taken 7%. They are not
Expected
taking
return
11%.
on the market is okay. Let's just do based on whatever we understand. Okay,
Okay.
first we, and then we can rectify. So expected return on the market is 11 percentage. So as per, if I have to use CAPM, I will say 11 percentage minus risk free rate is not given, right?
4% it's given.
Given. Okay, so 4 percentage. So
Acha, हाँ, okay.
beta is 1.2.
हाँ.
How much is this coming to?
Yeah. 12.4.
Okay,
Yeah, it's right. Yeah, I got it.
coming to 12.4
Yeah.
percentage. They have used 12.4, is it?
Yeah, yeah. They have 12.4.
Okay, then you calculate this amount.
3.3281. 61.63.
Just add this 61.63 plus 3.1105.
64.7419.
Okay. So now you can just use
CF
the cash
function.
flow function.
Yeah.
CF0 is 0. CF1 is 1.8. CF2 is 2.16. CF3 2.592. CF4 64.7419. And the interest rate is 12.4 percentage.
Okay, so in this sum, behind they have not done this calculation of 11 minus 4, and they have directly taken 7 percentage. And in the question also, there is this 7 percentage of growth rate. So I got confused. Why are they taking growth rate as equity risk premium?
Okay, okay, okay.
Okay, okay.
Just 1 minute. Okay, is this fine now then?
Yes, 45.69 is the answer.
You're getting it right?
Yeah, not 45.69. And then seventh one, sir.
Okay.
Hello.
Yeah, yeah. Yes, 1 minute, 1 minute. Okay, next question is what? Sixth one.
Seventh. Sixth one is H model, which is very easy, straightforward question.
Seventh one.
Yeah.
Johnson's supervisor also requested a calculation of the justified leading PE ratios for the two firms using a macroeconomic multi-factor model based on the information in table 2. Okay. Requested a calculation of the justified leading PE ratios for the two firms. Leading PE ratio for the two firms. Okay. Requested a calculation of the justified leading P ratio for the two firms using a macroeconomic multi-factor model. Macroeconomic multi-factor model. Using a macroeconomic multi-factor model. Using a macroeconomic for the two firms using a macroeconomic multi-factor model based on the information in table 2 on the previous page to estimate the required returns, assuming the earnings and dividends will grow at 5% for TST and 7% for A, the justified P ratios. Okay, so let me write the formula first of all. Justified leading P. Justified leading P.
Sir, I cannot see the board.
Not able to see. So justified leading P ratio is equal to
Dividend payout ratio upon
D1 by R minus G.
R minus
It's a
G.
leading one. So D1 by E1 is dividend payout ratio divided by R minus
R
G.
minus G.
That is dividend 1 minus retention ratio. That is equal to 1 minus B by R minus G. Okay, now what we require is required return using multi-factor model, and dividends will grow at 5% for TST and 7%. So dividend and 7% for AAA. So what is the current dividend then?
1.5 for AAA
Hmm.
and 4.6. Wait, 1.5 for AAA.
So 1.5, not
Yeah.
1.5. And what is the earnings?
Earnings are 2.5 for AAA.
Yeah, so we will focus on AAA only now.
Okay.
So 5% for TST and 7% for AAA. Johnson supervisor also requested a calculation of the justified leading PE ratios for the two firms using a macroeconomic multifactor on the information to estimate the required return, assuming the earnings and dividends will grow. So dividends, how much you said? 1.5.
Yeah.
And
Earnings
earnings
are
is
2.5.
2.5. So dividends is growing at what rate? 5%, right?
5%.
Dividend and earning both will grow at 5%.
No. It's not 5%.
Yeah, here it is mentioned.
5% for
Acha, 7%.
7%.
Calculate.
Okay. 1.605.
For earnings,
Yeah. 2.675.
earnings and then dividends. Okay.
Yeah.
So dividend and earning means this one. And G also we have growth. Now we require only R. So required return using macroeconomic multi-factor model. Okay.
Here, what is confidence risk?
Confidence, you don't trust that company. Some companies are very trustworthy, like Tata.
Mm.
Okay, some company are not so very trustworthy, like Paytm or this Ola, uh, or Adani also. Okay, so here how do we calculate? Using all macroeconomic factors, they said, right? Macroeconomic multi-factor model. Macroeconomic multi-factors model. Just 1 minute, okay.
Hello.
Okay, yeah. Okay, this one, yeah. Um, okay. So we have to find out required return, right? So required, only R is the problem now.
Yeah.
So G also we have, it is 7%. R is based on multi-factor. So
So we
multi-factor
can
risk,
use CAPM in this,
uh,
like we found, how like we did in
not
previous
CAPM,
sum.
not CAPM. Risk-free is 4%. Reason being, only multi-factor models. All these are
So
macroeconomic multi-factor models. All these are
car hat
macros.
model and all.
Yeah, all these are macros, right? So
Yeah.
Carhartt, whatever is given, all this you have to use. So here 4% plus. Now these are beta 0.63
Huh.
of 0.4.8 percentage.
Sorry, sir, I did not get it. 0.63 or
This
4.8
is the
percentage.
sensitivity, na? This is the premium, risk premium,
Okay.
4.8 percentage plus 0.47. This is the sensitivity, 0.47.
But this sensitivity is of time horizon and this sensitivity is of confidence risk. So how are we adding both of these two into confidence risk?
Where am I adding both to?
So
This is a
we did
separate one.
okay.
This is required return based on all multi-factors, macroeconomic. All these are macro multi-factor. This
So
is one
see,
factor.
ha ha.
This is another factor.
Acha, ha, okay, okay, okay.
0.47
Ha
based on 3.1
ha ha. Okay.
percentage plus 0.70 based on 4.5 percentage plus 0.98 0.98 based on 3.8
3.8%.
percentage. Uh, 0.05 into minus 1.8
1.8
percentage,
percentage.
minus 1.8 percentage. So 4% plus, calculate this,
Yeah.
convert it into percentage. You can simply type 4.8 into 0.63
Okay.
and store root.
$14.1461. The overall, the total. By
All this you
adding,
have added
yeah, by adding 4% also.
14 point.
1461.
Okay, so in that case,
So this only the total of all these betas, the excess premium would be 10.1461.
1.605 divided by 2.675 whole upon 14 point. What did you say?
1461.
1465.
1461.
1461% minus 7 percentage. Now you solve all this.
8.3961 percentage.
How percentage? This P ratio is not a percentage. What is
Okay, okay, okay,
numerator
okay.
number?
Okay, wait. One. Acha, that's PE ratio. So 1.605 divided by 2.67. 0.6.
14.1461 minus 7.
7.1461.
Okay, this is percentage. Now 0.6 divided by 0.071461.
0.025.
What? This is 0.025.
Yeah.
No, something is wrong. Okay, let me calculate. Hmm, 8.39 it is coming to.
What is coming to 8.39?
But still that is P, no, the P
7th one.
ratio. But still that is not matching anywhere. Okay, let's see the answer then. This one, right?
18.3. B. B is the answer.
Hmm. Huh. So here, um, 15.27. You said it is 14.14.
Yeah.
15.27. So 1, 2, 3, 4, 5. So 1, 2, 3, 4. So what? I think there is something wrong in the calculation of R. 4 percentage, 4.0.42 into 4.8.
0.42. How are they taking 0.4?
4.8 and 0.42. Okay, did I take then another company's sensitivity I might have taken?
We are doing it for AAA, na? So 0.48 into 0.63, that's right.
Wait, I'll open another file. It's confusing. Okay. $73.
Sir, page 43.
This is the question, right?
Yeah.
This is the question. Question is 7th question.
Yeah.
Oh.
15.27. So we got another one, 14.14.
Yeah.
So why? Now this is 4.8% into 0.63.
We are doing it for triple A.
4.8 into 0.63, correct? 4.8 into, what did I take? 4.8 into 0.63 and 4.8, correct, only this one. 3.1 into 0.47. 3.1, 0.47. 4.5 into 0.7. So this is okay. 3.8 into 0.98. 0.5. So you have done calculation mistake.
Okay. I'll do it again, sir. 2 minutes. I'll do it again. Okay, sir. I got 15.26.
Hmm.
Yeah.
Okay. Then you change the numbers then.
Yeah. 7.25 is the justified fee of AAA.
When you solve all this, what are you getting?
Huh?
When you solve all this, what are you getting?
Yeah. So I'm getting 7.25.
7.26.
Yeah.
Which is, that is not, okay. 7.26. B. Same way
Yeah.
you have to do for TST.
Yeah. So in the calculation, I took 0.47 at one side and then on other side like 0.63 on one side and 4.8 on other side. So I did not take percentage. I did not count for percentage.
Hmm.
Okay.
Okay. Okay, what is the next doubt?
Next one, sir. 8th and 9th was okay. I have not done last three sums. Last three one.
Okay,
I'll
fine.
do
So
it.
that you do it later.
Yeah,
Then
I'll
I'll
do it.
continue now.
And then, sir, I also tried this. I tried it today morning. I did not solve it, but I just saw. You said no to. You said no, na, for this 19.1.
19.1.
Yeah, you said one of.
One module quiz, I will do
Yeah,
it, I said.
yeah.
Yeah, yeah.
So it was 19.1. I just did it.
Yeah, this one, couple of questions might be difficult.
Which
So
one?
this module quiz, I'll do it. This one, 19.2.
Sir, we are yet to start 19.2, no?
Yes, yes, yeah.
So I did 19.1 also. Two questions
Hmm.
were there. It was easy.
Okay, so from here I'm supposed to begin, right?
Yeah.
Capital X.
Yeah.
Yeah. So from here. Okay, this formula we already know.
Yeah.
Free cash flow. Free cash flow to the firm.
Yeah.
Free cash flow to the firm. Okay, this formula we know. The next one,
Yes.
yeah, so fixed capital expenditure.
Sir, we did this.
Yeah, yeah. I'll just write it down because all related to fixed capital, I'll write down the formula. Fixed capital investments is equal to capital expenditure
Minus proceeds from sale of long-term assets.
minus fixed capital investments is equal to capital expenditure minus proceeds from sale of long-term assets.
Yeah.
If no long-term assets were sold during the year. If no long-term assets were sold during the year,
Sir, but
then
this ending net PP and E will be same as beginning plus no, okay, yeah.
fixed capital investments is equal to ending net
PP and E
PP
minus
and E minus
beginning net
beginning
PP and E plus depreciation.
net PP and E plus depreciation. If no long-term assets were sold during the year. Okay. If no long-term assets were sold during the year, then if no long-term assets were sold during the year, ending net PPE minus beginning net PPE plus depreciation. Have you understood this one? What it means? See,
Yeah.
for example, see, opening was 10,000.
Hmm.
Okay. opening was 10,000,
Then
and
we added 3,000 more
yeah,
PPE.
yeah, ending PPE minus beginning. So let's say ending is capital investments. Okay, I think examples are given here. Next, some examples are given. Ending net PPE minus beginning net PPE, and then because we have used depreciation also,
Yeah.
so that is also an investments in fixed capital. That is the reason. Okay.
So
Hmm.
ending
Okay.
was
So say for example, ending is 10,000,
uh,
beginning is 7,000.
uh.
So
So
3,000,
we added new PPE,
3,000,
na?
yeah, 3,000 we have invested. Along with that, capital expenditure is imagine 1,000 rupees. So total 4,000 is the fixed capital investments.
Capital expenditure, like if we have added 3,000 new PPE, that is our capital expenditure, na?
If we are adding 3,000,
That is only our capital expenditure. PP&E is
yes,
plant
yes, but
property and
also the
equipment.
depreciation that is happening, that is also capital expenditure because that is an expense, right? Depreciation.
Yeah.
So that also comes under capital expenditure.
Okay.
This is the cash, this is the non-cash. You
Okay.
can say like this. Okay, just hold on 1 minute.
Okay.
Hello?
Yes,
Hello?
sir. Yeah.
Yeah. Okay, this one. Okay, another one. Calculate fixed capital expenditure. So here, fixed capital expenditure, another formula. Another formula is ending net PPE ending net PPE minus
Beginning net PP
beginning net PPE
plus depreciation
plus
minus
depreciation
gain on sale.
gain on sale. If there is loss, then add instead of. Okay. So ending net PPE minus beginning net PPE plus depreciation.
Yeah.
Suppose if there is so the previous one was assuming there is no sale, if no assets were sold. So I think better you remember this formula only. This covers all.
Yeah.
And if there is no sale, then you can mark it as 0.
Yeah.
Right. Okay. Yeah. So this seems to be the best one. Okay.
Yeah.
Ending net PPE minus beginning net PPE plus depreciation minus gain on sale. Okay. You understood the reason behind it?
Yeah.
Okay. Because
Yeah.
this gain on sale is the cash incoming. So we are reducing it. Okay. If formula is clear, it is just the plugging in of number. So Airbrush Inc. financial statements for 2022 include the following information: selected financial data. Okay. Gross accumulated depreciation net PPE. 2022-2023. There were no sales of PPE during the year. Depreciation expense was 300. Calculate Airbrush's fixed capital investments for 2023. Okay. So fixed capital investment, this is the formula. Now this is gross accumulated and depreciation. So net is 3,500. And this is 2023, 2024. So 22. So ending net PPE, ending is 3,500.
Yeah.
Minus beginning net PPE is 2950.
2950. So it will be 550 plus difference average. So we have to take
Plus
average
depreciation.
depreciation or increase in depreciation.
Increase depreciation is so from 2022 to 2023, 300 is the depreciation, right? 1200 and 1500. Difference is
But
300.
why are we not taking
Accumulated is the previous one, right? All previous one. No?
okay.
For this particular year, 300
Ha
must
ha
have been
ha
the
ha.
depreciation.
Ha ha ha.
Okay. Minus, is there any gain?
No.
Sale, nothing is there. There were no sales. Okay.
Yeah.
So 0.
So
Calculate this.
550.
550.
550 plus 300 is 850.
850.
Yeah.
Note this is the same as the change in gross PPE.
What?
Yeah. This is the change. This is the same as the change in gross. Gross PPE 850.
Okay.
Yeah,
So
4150 and 5000. Okay.
so every time the answer will be the same. The change in gross PP will be the answer.
If no sales are taking place.
Oh, yeah. So the
Sales.
difference between gross PP will be the answer.
Yeah.
Okay.
Okay. Suppose next one, calculating fixed capital investments with long-term asset sales. Suppose that Airbrush reports capital expenditure of 1400, long-term asset sales of 600, and depreciation expense of 850. The long-term assets sold were fully depreciated. Calculate Airbrush's received fixed capital investments for 2023. Suppose that Airbrush reports capital expenditure of 1400.
Yeah.
Okay. 1400. Long-term asset sales. So there is a sale. Depreciation. So 1400 is the capital expenditure. Then long-term asset sales. So sales minus depreciation plus 850.
Plus 850.
Depreciation expense of 850. The long-term assets sold were fully depreciated. Okay, here they are not reduced to
Including
depreciation.
the depreciation, no, because they're fully depreciated.
Okay, why depreciation is not added over here? Capital expenditure. Okay, reports capital expenditure of 1400, long-term asset sales and depreciation expense. So capital. So that means this 1400 includes 850.
850, yeah.
Okay, so it is the first formula. So capital expenditure, this includes depreciation also.
But always does it includes depreciation?
Yes, yes. Yeah. The name capital expenditure itself is like net kind of thing. I mean,
Okay.
except sales.
So 800.
Yeah. This table you don't have to refer. It is just that what we did. You
Yeah.
know, that 4 types, that one.
Yeah. So next, all
So,
2-3 pages are that only.
yeah, yeah. This almost FCFF you can ignore. Nobody will ask you almost FCFF and all. Accurately, whatever we have done, that one only. Okay.
Okay.
So almost FCFF you can ignore. FCFE we have done this one.
Yeah.
FCFF we have done this one.
Yeah. From EBITDA also we have done.
Yeah, this is also done.
And from CF also we have done.
Hmm.
How many questions from equity can I expect in exam?
Equities weightage total 44 I think uh, questions. So total morning 44, afternoon 44.
Yeah.
So out of that, around what percentage is equity? 15 percentage, right?
Yeah.
15. So 15 percentage of 88.
But now there is no session-wise subjects like in level 1. I can get any subject from any in any session.
No, subject wise only it will be.
Subject-wise only it will be.
Yeah, yeah.
So
Yeah, subject wise it will be.
first session ethics and all, and FSA and ethics eco and all.
First is
All the
no
tools.
morning all 10 subjects, afternoon all 10 subjects will be there.
Okay. Okay.
Both the sides 10.
Okay.
Okay. Then FCFE, this also we have done. FCFE, this formula is also done. FCFE, CFO minus fixed capital investments plus net borrowing.
Yeah.
Hmm. 19.2, 19.3. Okay. Use the following information to answer questions 1 through 3.
Yeah.
Okay, just go through this question now.
Wait a minute, sir.
Free cash flow to the firm, and these are all the transactions. Okay, so first I'll write the formula. Free cash flow to the firm is what? Net income. Have they used net income? Depreciation, deferred tax liability, reported income. Okay, so net income plus depreciation, then what? Plus interest into 1 minus tax minus working capital investments minus fixed capital investments. Okay, so see, Mayor Henderson, CFA, is analyzing the financials of Roth department stores. He intends to use a free cash flow to the firm model to value Roth's common stock. In the 2023 financial statements and footnotes, he has identified the following items. Item 1, Roth reported depreciation and software amortization of 23 million. So 23. Okay. Then the deferred tax liability increased 17 million. Deferred tax liability is increased. Where will that come?
Hello, hello.
Hello? Yeah.
Yeah, sir. I was not there for 2 minutes. I said that I had been for the. I'd gone for the charger. What did you say?
Huh. No, I was just reading this and I did the first transaction. Depreciation is 23.
Okay.
Okay, so I added 23. The deferred tax liability increased. So deferred tax
So
liability is
it will. You will add that, no? Yeah, you will add that.
deferred tax liability increased by
If
17 million.
liability increases, then we'll add that, no?
Yeah.
Current liability increases.
Deferred tax liability 17 million. See, this is cash. So liability means what we are supposed to pay, we did not pay. So it is going up. Yeah, so I'll write it here. Deferred tax liability
Yeah.
17 million. Then next one, Roth reported income of 6 million in 2023 from the reversal of previous restructuring charges relating to store closing.
Roth reported the income of 6 million in 2023 from previous restructuring charges.
Okay. Reported deferred tax liability increased. Okay. Reported income of 6 million
So
from
this will be
reversal of
other incomes, na?
previous.
Other
Yeah.
incomes, na?
Yeah.
We
See, previously we reported
will
and
deduct those.
reported income of 2023 from the reversal. So that means we are getting this 6 million.
Yeah. So we'll
So
deduct it, na?
no, cash is going up, right? Cash perspective, you have to think cash is going up or down. Okay.
But that, so we will add that. That thing is already added into the net profit, na? So why are we adding that again?
Reported income of 6
The
million
income is reported
in 2023
yeah.
from the reversal of previously charged. So previously you charged and now you have reported income. So previously you charged. Now there is no Um, there is no addition of cash, right? We charged last year and then we reversed it this year. So the cash is not going up.
So no, if we have charged it,
Huh.
like charge in what sense? I did not understand charge in what sense. Like
See, what happens is, what happens is, in a company, merger acquisitions all are
uh,
quite normal.
uh,
So when they talk about this merger and acquisitions, they enter into some sort of consultancies and all that thing,
uh,
right? So they will. So what they will do is when this kind of talks are going on, they will keep this kind of charges aside, and then most of the time it
so this is something they have to pay to that investment bank.
yeah, but then after that it doesn't materialize also. When it doesn't materialize, then they are supposed to reverse it, right?
Yeah. So they kept that 6 million aside if they have to pay it to the investment bank, but that thing didn't happen, so now they are adding it back.
Yeah.
Ah, okay. But then this is a non-cash income, na?
Yeah, this is a non-cash income.
So
Okay, that's why we
non-cash
should not
income
do anything. Let me.
gets deducted. In level 1, the non-cash income used to get deducted.
uh, Reported income of 6 million in 2023. Let's not do anything now. See, because I think, let's see if it is a mistake. See, reported income 6 million. So cash. See, this year's okay. No, this year's cash must have gone up because of that.
Yeah,
I mean, net income must have gone up.
yeah,
So in my net income, extra amount has been added. So I should
yeah,
deduct.
yeah.
Yeah. Roth reported income of 6 million. So minus restructuring charges. Okay, let's see if it is a mistake. We'll see. Minus restructuring charges. $6 million. Okay. Net income 173. The net increase in non-cash working capital 47. Then net capital spending total 86. Reported net interest expense 19. What is tax? Tax is 35%. Henderson estimated Roth's marginal tax to be 35%. He also expects Roth to be profitable for the foreseeable future, so does not expect the deferred tax liability to reverse.
Okay.
Okay. So he does not expect the deferred tax liability to reverse. That means that cash will go up. Okay, fine. This is added. Okay. As the base year projection for the FCFF valuation, and Henderson calculates FCFF for 2023 as follows. So it is what they have calculated.
Yeah.
So let's see.
What are we getting?
Yeah.
One,
So this is okay.
173 plus
23
plus 72.
6 they have added and we have reduced.
Okay.
So this we will see. Then 17 they have added. 19 into 1. This is okay. This is okay. This is okay. So this one thing we will just see. Okay, whether it is right or not. Okay. See, first one, in implementing the FCFA model to value, did Anderson correctly treat items 1 and 2? 1 and 2. So according to us, this is the wrong one. Okay, let's see. Items 1 and 2.
P. So according to us, one is
Depreciation,
right and one is wrong, no?
deferred tax liability is also right only. No? Both are right. Both has been added.
Acha, हाँ, okay, one and two. Yeah, both are
Now
right.
you keep checking the answer.
Okay, wait.
Both are treated correctly. A, according to us.
19.2 A, yeah.
A is right, no?
Yeah.
Okay. The next one, in implementing FCFF model to value rod, did Anderson correctly treat items 3 and 4?
So according to us, one item was
3,
treated correctly and
3,
other one was no.
okay, 6 million. This is wrong. And another one is 3 and 4. 173 is right. So this, okay, just
But
check this one.
how can we say that 173 is right?
Okay, that you have to see the explanation then. But it is a simple one only, net income only. The doubt is all restructuring one only.
Yeah,
No?
B is right. B is right. But
Then it is okay. Correct.
if
Okay.
he is testing us on the whole case study, so how can we trust that 173 million is also right?
Whole case study means net income is not a controversial thing. No, only
Okay.
this one is little tough, right? Restructuring.
Okay.
Third one. In these two terms are only little difficult. This deferred tax liability and this. I think rest all should be fine only.
BPL is, I think, so right. Like we have to add it.
Third one, in implementing FCFA model to value, did Anderson correctly treat 5 and 7? 5 and 7. 5 is working capital. This is easy. 47. 5, 7. 7 is 19. This is also fine only. So both should be right. Both should be right. Check.
Yeah, A.
Okay. Yeah. Okay, fine. Then this is a new one. Okay. So next one.
So this is not connected to the case study.
No, not connected. Imagine that we have provided the following information for your phone. Okay. Net income 50, working capital investments for beginning gross fixed assets 90, ending gross fixed assets 138, 136, beginning accumulated depreciation 30, ending accumulated depreciation 40, depreciation expense 27, net borrowing 0. In addition, a piece of equipment with an original book value of 19 was sold for 10. The equipment had a book value at the time of sale was 2. The gain was classified as unusual. Free cash flow to equity is closest to. Okay, so based on all this, net income. First, I will calculate free cash flow to the firm. Okay.
So net income plus depreciation plus interest minus working capital minus.
So net income
Fixed capital
plus interest.
depreciation.
Interest into 1 minus tax plus depreciation minus working capital
minus fixed charge
minus fixed capital investments. So net income is 50.
50. Working capital is 4 minus 4.
Interest is
Net borrowing is 0.
Interest is not given. Depreciation expense is 27. Working
but accumulated
capital.
What should we
that
do?
All that, yeah, that is, see, this case is more about fixed capital investments calculations. Okay, wait. Working capital is what? Working capital is 4 directly given. So now fixed capital investments is what we have to calculate. Now we know fixed capital investments.
So we have to use that PP&E
net,
formula.
Ending net PPE. Okay, right?
Yeah.
Minus beginning net PPE
Plus depreciation
minus sale of assets. Okay, so ending net will be
136 minus
beginning
90.
gross minus accumulated depreciation 60, no?
Okay,
Ending will be 136 minus 40.
which will be 96.
96 minus
60.
beginning is 60 plus depreciation is
27.
27 minus sale of assets is sale of gain on sale of assets.
A
Gain on
a piece of equipment with original
ah,
book value was sold for 10.
okay.
So it is a loss now. We'll add 9.
Was sold for 10.
The
Original book value was 19, was sold for 10. The equipment had a book value at the time of sale was
Acha,
2.
it's 8. It's 8.
8 rupees gain.
8,
So
yeah.
minus 8. Just calculate.
Uh, 36 plus 27, 36, 56, 63 minus 8 is 55.
55.
Yeah.
So this is 55. And also remember one more thing. When you get this gain on sale of assets, you
Yeah.
should reduce from depreciation also. Okay.
I did
Remember
not.
this one.
Acha, okay, yeah.
Because even depreciation is an expense, but it is giving you some gain as well here
Yeah,
by
yeah,
selling.
yeah.
Okay, now you add up all this. 50 plus
So
21
50 plus
minus 4
21
minus
is
55.
71. 71 minus 4 is 67. 12.
Overall, it is what? 12.
12.
Free cash flow to equity is what? Okay. So this is my FCFF. From
FCFF
FCFE,
minus interest, 1 minus
FC,
interest.
FCFE. So I'm not including this interest. So FCFE is FCFF, FC, FCFF minus interest into 1 minus tax. So here we did not add,
Yeah.
and here we are not reducing, so it is nullified.
And
1 plus
or minus net borrowing.
borrowing.
But net borrowing is also 0.
0. So this is also 0. So my FCFF only. So that means it should be 12, but
Yeah.
there is no such options, no? So, acha, so 12.
Is closest to, they are saying.
Okay, 1 minute. Wait.
Answer is B.
Wait. Sorry. See, there is this 1 minute. Sale of 2. We didn't get the, wait. The equipment had your book value at the time of sale. Answer is, what did you say?
B.
Wait. We were sold for 10. The equipment had your book value at the time of sale was 2 rupees. So 8 rupees is the gain.
Yeah.
2 rupees. 1 minute. As per our calculation, it is coming to 12, right? Okay, just check the answer, see where we have gone wrong.
Sir, in this,
Acha, 1 second. 27 minus 8 is what?
21, 19.
So that is the problem, no?
Yeah,
It is correct only what
yeah,
we
it's
have done.
correct. It's correct.
Yeah, so this part you have to remember, the depreciation. And this is the formula only.
Yeah.
Okay. What is the next question?
Fifth one.
Fifth one. Suppose an analyst uses the statement of cash flows to calculate free cash flow to the firm as cash flow from operation less fixed capital investments. And okay, an analyst calculates free cash flow to the firm using cash flow from operations. So normally, how do we calculate? CFO plus interest into 1 minus tax minus fixed capital investments.
CFO plus interest.
Yeah, because it is
Okay, yeah.
firm, no?
I
Okay,
was
and
thinking of
that will come
CFCF.
to FCFF.
Oh,
From this, what will we do? We will reduce interest. From this FCFF, we will reduce interest into 1 minus tax. Then plus or
reduce
minus net
fixed
borrowing.
capital.
Sorry, no.
Yeah, plus or minus net borrowing and then fixed capital. We'll
Yeah,
get
minus
FCFE.
fixed capital plus or minus net borrowing.
Yeah.
Now, CFO, okay, they are saying uses the statement of cash flows to calculate free cash flow to the firm
Yeah.
as cash flow from operations less fixed capital investments. That means this is not included.
Yeah.
Okay, and free cash flow to equity. This is free cash flow to the firm. From this, what we will get is free cash flow to equity. So, and free cash flow to equity as FCFF plus net borrowing. Free cash flow to the firm minus, why will I minus again?
Yeah, that's what I was
Wait, just wait, okay, there is so much of noise here. Hello? Hello?
Yes, sir.
Yeah, we'll stop from here, okay? We'll just finish this off and stop from here. See, this is FCFF. Now, why will I reduce fixed income? Why did you say fixed capital I have to reduce? I have already reduced here.
Okay.
This is not a part of the formula. So FCFF minus interest into 1 minus tax plus or minus net borrowing. So this I have not reduced. So here also I am not, here I have not added. So here I am not reducing. So it is fine. Then net borrowing is anyway 0. 0, right? No?
Net borrowing is it's 0. If it's connected, the fourth
No.
and fifth,
Number, where is the number given? Number is not
there is
given.
no
See.
number given. I think the fourth and fifth are connected, then it's 0. But in fifth
Okay,
one,
wait.
individually,
Let
there
me
is no
read
number
again.
given.
Wait. Let me read again. Suppose an analyst uses the statement of cash flows to calculate free cash flow to the firm as cash flow from operation less fixed capital investments. Okay, see, the question is whether it is overstated, understated. So this is free cash flow to the firm. So that means this interest has not been added. So it is understated. It is understated. Now here, when I say FCFE, this number comes here, and because I did not add here, I am not deducting here, so it is fine. And then, so this is understated, means it should be between these two, and then plus net borrowing has been added. So this is correct only.
I did not
FCFE
get
is
it, sir.
correct.
I did not get it.
See, this is 100 rupees.
Yeah.
This interest is 10 rupees. Fixed is 50. So now this 10 you have not added. So it will show as what? 150.
Yeah.
It is understated.
Because we have to add 10, but we have not added, so the amount will come less. Okay.
Understated. Now this I will bring it here. Ideally, if I would have added 10, I would have reduced here. So it doesn't matter for FCFE.
Okay.
Because I did not add here, I am not deducting here. And then I added this net borrowing. Net borrowing is, let's say 20.
20, okay.
So it will be, so that means I have calculated FCFE correctly only.
Okay.
Because this mistake of not adding interest in the FCFF does not affect in FCFE. Because if I would have added also, I would have deducted here. So my FCFE is correct.
Suppose an analyst uses a statement of cash flow to calculate FCFF as CFO less. Okay. So FCFF in FCFF he has only deducted fixed capital from CFO. Okay, and in FCFE as FCFF plus net borrowing. Okay. Firm has short and long term debt on its balance. What is the meaning of debt on its balance sheet? Okay, so they have debt in their balance sheet, but then too they have not deducted. They have not added interest in it.
Plus net borrowing, the firm has short and long term debt on its balance sheet.
Yeah. Okay. Got it.
Okay. So it should be C.
Wait, I'll check it. Yeah, it's C. Okay.
Free cash flow to the firm.
Sir, I can do this on my own.
Okay. Anyways, we will do this next time.
I'll try this.
Yeah, you try.
Yeah, I'll try
this is just all easy one only.
Yeah.
Okay. Fine. We will then stop now here.
Okay. Okay, sir.